What is the Federal Reserve doing? I was thinking about recording this and then I kept flopping back and forth and I was like, wait a second, our listeners need to understand what is actually happening right now and be paying attention because the Federal Reserve is sitting there pausing while the rest of the world has already started cutting rates and the Fed is getting stuck in what I'm going to call the uncomfortable purgatory. The idea is this is that the stakes are high. We've got tariffs and trade wars and politics and inflation and unemployment and GDP. But what does this mean for your business? What does it mean for mortgages? What does it mean for all interest rates and your wallet? I just want to go over this really quick with you today. So the Fed is really split between this idea of tight monetary policy and stimulus monetary policy. That's what we're going to call the hawk, aka the tight money policy, and the dove, the stimulus money policy. And these ideologies are really kind of split down the middle. We're going to go through a scorecard where each one of the Fed members is today. But what's happening is Papa Powell is kind of out there herding the cats in a certain direction while things are changing on the unemployment front, changing on the GDP front, and changing with our inflation numbers that we just had come out last week. Last week, we had the FOMC meeting, and you get the summary of economic predictions. And so you get to see how each one of these Fed members is voting. So Jerome Powell, let's call him neutral, but I will say it's starting to feel like he's got a little bit of a political bias here. Like Trump's pushing and bashing against him have not been helping the case for lower rates because he just keeps saying, wait and see. The inflation data came out last week and it was lower than expected, but they're still saying we want to wait and see what happens. To give you the scale is basically, let's say 1 is a dove, 3 is neutral, and 5 is a hawk. Williams right now, who is the vice chairman of the New York Fed, he is a 2, so a little more dovish than neutral. Barr is a 2. Bowman is a 5. So Bowman's usually a hawk, but we're going to come back to her in just a second. Cook is a 2. Jefferson is a 3. Kluger is a 3. And Waller is a 2. Now you have rotating board members. And Collins is generally neutral. Goolsbee is, really on the dove side. And then you've got Musalium, and I'm not sure if I said that correctly, and Schmidt, who are both definitely on the hawkish side. But what's interesting with Michelle Bowman, even though that she was on the hawkish side just last week, she came out and said, so post the meeting, she was in Prague, and she said that the timing of the next FOMC meeting is in July 29th and the 30th. And that's when a rate cut could be on the table. These simple words caused the interest rates in the 10-year to move down because we've had the bombing of Iran, we had oil prices rise, we had the conflict rise. So everyone's expecting interest rates to go up. She's usually really hawkish, but these are very dovish comments coming from a Federal Reserve governor. My question is, now she trying to throw her hat in the ring to become the replacement for Mr. Powell. So you can see from most of these numbers that we're kind of decisively split down the middle. But as Bowman starts breaking ranks from her traditionally being a hawk, that's going to start to pull the Federal Reserve towards more dovish overall. With Goolsbee really being on the side of, we need to save jobs, we need the soft landing. The wild card that keeps coming up is tariffs. And what Bowman said is she believes it'll be a one-time price shock to the market. I actually personally believe that. We kind of know already that you're going to see somewhere between a 10 to a 15% tariff. Now, when you think about tariffs, you have to remember that's on the price of the good itself. That's not on services. That only affects one part of CPI. Second, it's the input price of the good, not the final price that the consumer pays. So the producer of that good has the ability to either pass that on to the consumer or take it in the margin. I do believe, especially when you look at the stock market right now, with earnings per share, EPS, being on the high side, that a lot of these companies have margin that they can just eat with these tariffs. So the consumer may not even see these tariffs. So by Jerome constantly saying, I want to wait, we want to see how the tariffs are going to play out, what he's actually saying is, I'm going to be a little bit political. I'm going to dig my feet in, and I'm going to wait until the data shows up. But what's interesting is, in the past, all you got to do is go back. All of this is recorded. They said they waited too long in order to raise rates and that they weren't looking at the data. Now they've flipped to the other side and saying, the data says it's okay, but we're waiting for the soft data to come in. So which one is it, Jerome? Are we playing politics? Are we waiting for the actual data to show up? And then if the actual data shows up, are you truly data dependent? And is that too late? In my opinion, right now, the Federal Reserve is already behind the 8 ball. And the reason they're behind the 8 ball is you can see inflation trending in a downward direction. But I do believe your next couple inflation reports, just because of how the CPI and the PCE are calculated, are going to come in slightly higher. I do believe that we've overall beat inflation and that tariffs are not going to cause some gigantic shock to the system. So you've got all these other central banks across the United States that have already started their cutting cycle, and the US is just waiting to be last. What I believe is going to happen is, if we don't get this under control, the unemployment rate is going to dramatically rise and the employment market's going to break. You can see this in the number of job openings that are available is going down, and the people who have been unemployed for longer periods of time can't find work. And I forget what the stat is. It's something like they measure people who have been looking for work more than 6 months. So in other words, the unemployment market, or in the employment market here in the United States, is showing signs of cracking. You can't wait to cut until it actually cracks. But everyone goes, but the Fed will just step in and print their way out of it. I don't want them to print their way out of it. They're printing their way out of it in COVID is what caused all this inflation to happen. If we have to print our way out of it, we're going to receive more inflation. We're just devaluing the dollar more. As we devalue the dollar more, what does that mean? It means only asset holders get to benefit in the ride. So people who own stocks, people who own gold, people who own real estate, like us, our listeners here. The way we measure inflation here in the United States, I believe, is one of these backward-looking indicators. If you want to go and look at trueflation, I think this is actually showing a better example of what's happening with inflation today. And you can see that the inflation has basically peaked out and it's getting ready to start cooling again. It's sitting at 2.16. This is measuring more real-time data than what the Fed is measuring and how we measure inflation here in the United States. So if we've beat inflation, the question I want to ask is the Fed then just being political and using the cover of tariffs, using the cover of we have to wait and see and be data dependent, because there are economists that are predicting inflation from tariffs is going to show up, but we have not seen it yet. And our economy is getting to the point where we are hitting the stall speed. And what this is causing is, this is now causing massive political rift and tension. You've got President Trump, unfortunately, calling him names. You have other politicians literally saying it's time for rate cuts. I personally believe it's time for rate cuts. We officially beat inflation. Isn't 2.1, 2.2 close enough to 2? I mean, just in the last decade, we're actually worried about deflation. And as things like AI start to grow even more in our economy, that will be massively deflationary. Deflation is just around the corner. We already talked about how the other central banks are cutting, but let's be very specific. We're talking about the EBC, the Bank of Canada, the BOE. And why have they started cutting rates? They've started cutting rates because their economies were already slowing down. It's a global economy. Ours is starting to slow down too. And what's interesting is, ironically, when the US, because we're the reserve currency, when we hold our rates higher, it's forcing other people to cut faster. This is a feedback loop. So what's the pros and the cons of staying put? And then let's talk about this in relation to interest rates and real estate. The pros and the cons are: pros, we know we're going to get inflation under control. We know that this provides credibility to the Federal Reserve. We know it allows the Fed to appear to be nonpartisan. We know that this creates more time for them to assess tariffs. The cons, though, are slower growth, higher unemployment, angry consumers, and possibly having the economy go into a recession and maybe even a deep recession that could be avoided. See, this slowing down of the economy right now is all self-induced due to the higher rates. The scenarios that we really have in front of us is that the tariffs start to fade, the Fed cuts rates, and then we end up with a soft landing. Today, I feel like that's 25%. And scenario two is that tariffs spike inflation and the Fed has to keep tightening and it gets worse and worse and we go into a bad recession. Scenario number three, we end up with stagflation. We end up with a slowing economy. We end up with rising inflation and we're stuck in the quagmire, like Japan was, and we lose years to stagflation. Scenario number four, the politics to hijack the Fed, they win and the Fed loses and the markets lose trust. And as us consumers, we end up with higher interest rates. Scenario number five is that the Fed waits a little bit too long and we end up going into a recession. Right now, I think the odds of the recession are like 50, 60%, with those other three kind of making up the other 25%. In other words, it's still kind of a wide open table. But the longer that we wait, the higher the likelihood of a recession becomes and the more political it seems that the Fed is being. So like I said, the Fed is kind of stuck because we believe every option sucks just a little bit for them. There is no perfect option here. However, I will say I believe they should start cutting rates now. What does this mean for us in real estate, us in business, for consumers? Right now, if you look at 30-year fixed debt, you can simply go look at the 10-year Treasury. Take the 10-year Treasury and add 2.5% to that. The average spread is 1.8. So if you had 2.5%, that means interest rates today are at just about 6.8%. If we were at the natural spread, that means interest rates today would be at 6.1 if the natural spread was there in the market, if lenders weren't trying to get more for what they call perceived risk. So one, that's a vehicle to get us into the low sixes. Two, we know that the politicians and the Trump administration is going to continue to scream at Jerome Powell that he is wrong. If they win and he starts cutting rates, then that could get us, of course, to lower rates. Regardless, we know that we know that Powell is up for re-election in 2026. And when that re-election comes up, ask yourself, is Trump and the current administration, are they going to elect someone neutral, a hawk, or a dove? They are going to push in the most doviest dove we've ever seen. So even if we don't get low rates in 2025, you can bet money by second quarter of 2026, we're going to have a new Federal Reserve president, and that individual is going to be a dove. And that's going to start to suck rates down. So whether that starts to happen in this year or next year, I will bet it happens within the next 12 months. Well, what does that mean for real estate? As rates come down, demand goes up. Okay, so for buyers, that means more activity, which means now is probably one of the good times. For sellers, if you're a move-up seller, now is probably a time to do it because you're going to be able to fight with less buyers. But if you're going to be downsizing or you don't have to sell, you may want to wait until next spring for rates to come down so there's more activity on your particular property. That's going to be on a case-by-case basis. For our investors, one of the things to think about is as rates come down, cap rates will naturally come down with them. And more investors mean more offers. So deal season is now until probably January or February of next year, even if rates do come down. We want to be making offers with hardcore terms attached to them. We want to be getting good deals. We want to be getting money off of the price. And yes, I believe there will always be deals, but I think there's a unique opportunity happening for us here over the next 6 months. For consumers as a whole, as inflation continues to trend down and as rates come down, understand that this means auto debt's going to get cheaper, credit cards are going to get cheaper, lines of credit get cheaper, but it also means businesses' debt gets cheaper and their lines of credit gets cheaper, which means more hiring opportunities in the future. So I'm more optimistic than pessimistic, but I am cautiously optimistic today. I think the Federal Reserve needs to cut rates, and we need to start moving like the rest of the country, the rest of the world is doing right now, towards lower rates to keep the economy from going into a recession. Because if we do go into a recession, this is a self-induced recession. If there's something I missed, hey, drop that in the comments below. If you guys have any questions or you know someone else who should be listening to this, please share this with them and hit that subscribe button. Thanks for listening today.